Can you show an example of an ITM put option trade? Have you ever wondered how an in-the-money put option trade actually works? Let's break it down with a clear example that illustrates the concept. An in-the-money put option is one where the strike price is higher than the current market price of the underlying stock. This means you have the right to sell the stock at a price that is more favorable than what the market offers. Imagine stock XYZ is currently trading at $55 per share. You decide to buy a put option with a strike price of $60, and you pay a premium of $8 per share for this option. Since the strike price of $60 is above the current stock price of $55, this put option is in the money by $5. This $5 is the intrinsic value, calculated by subtracting the market price from the strike price. The remaining $3 of the premium represents extrinsic value, which factors in time until expiration and market volatility. In this scenario, you have the right to sell XYZ shares at $60, even though the market price is only $55. If the stock price drops further below $55, the intrinsic value of your put option increases dollar for dollar with the decline in stock price. This means your profit potential grows as the stock price falls. However, to make a profit overall, the stock price must drop enough to cover the $8 you paid for the premium. For instance, your break-even price at expiration would be $60 minus the $8 premium, which equals $52. If the stock falls below $52, your put option trade becomes profitable. On the other hand, if the stock price stays at or above $55, your option will lose extrinsic value as time passes. This could lead to a loss limited to the premium paid, which is $8 in this case. The maximum loss on this long into money put option is the premium you paid. The maximum gain occurs if the stock price falls to zero, allowing you to sell shares at $60. This example clearly shows how an in-the-money put option trade works. You pay a higher premium upfront for intrinsic value and the right to sell at a favorable price, aiming to profit from a decline in the underlying stock price. The option's price moves closely with changes in the underlying stock price due to its intrinsic value component, making in-the-money puts more sensitive to price changes than out-of-the-money options. This sensitivity can lead to quicker gains or losses depending on the stock's movement.